The Australian Financial Review.
Hello, I'm James Thomson, Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is senior Chanticleer columnist at the Fin, Tony Boyd. Hi Tony, how you going?
Great, James, and isn't it great to be so near Christmas?
Oh, don't remind me. The end of the year rushes up very fast. All right, this week we are going to take you inside the mind of one of the world's most famous investors. We'll ask what's next for interest rates and we'll look ahead to the COP27 meeting in Egypt. But first, Tony, it's been a bit of a quiet year for mergers and acquisitions in Australia, but Thursday brought a good old-fashioned takeover fight between a few of our most famous fund managers. Now, Regal Funds Management, which is recently listed on the stock exchange, has made a bid for Perpetual. And that's in an effort to prevent Perpetual merging with another fund manager called Pendal Group, which has its roots in the bankers' trust empire that was so famous in the 80s and 90s. Now, Tony, this is a sort of three-way tussle. Tell us a little bit about the personalities that are involved here.
Yes, well, on the one side, you've got the Perpetual CEO, Rob Adams, who's been in the industry for his entire career. And his chairman is Tony D'Aloisio, who was a noted lawyer, former chairman of ASIC, and until last year he owned the Oak Ridge Wines in the Yarra Valley. So, interesting array of investments. And they're trying to buy Pendal, which of course is headed by Nick Good, who I think was planning to leave the firm when Perpetual took them over. And that company's chaired by Deborah Page, who a former KPMG partner who worked at CBA. And then the third big player, and I suppose this person is the most interesting, Phil King, former Macquarie sell-side broker who actually, he's made sort of cycling his main exercise, so he's actually a middle-aged man in Lycra. But no, Phil has, over the last few years, built up a reputation as probably the biggest risk taker in funds management, and that's delivered incredible returns and allowed him, through his long-short strategies, which means you borrow stock to invest in a company that's going to go bad. And then you buy it back when it's cheaper. And what that means is that his $5 billion under management is actually worth about like $10 million in money being managed when you include the debt. So, and on Friday there was an interesting update where Pendal released their financial results and said that everything was on track for the Perpetual merger to go ahead. But that looks strange when you see the share price has fallen about 12% just this week. Yeah. So, I think you spoke to Nick Good, didn't you, from Pendal? What's the story?
I spoke to him this morning and I said, it's time to get onto the elephant in the room, Nick. Will your deal go ahead? And he thought, I thought we were going to talk about cricket. He's a Englishman and he's hoping the Poms can win the T20 World Cup that's going on. But no, his sort of point is that Pendal and Perpetual have a legally binding contract, and from his point of view, the deal's going to go ahead. Tony, I just wanted to get an update from you. Obviously, we learnt last week about your family connection to a runner in the Melbourne Cup, Stockman. Update us. How did Stockman finish?
Well, Stockman came in 8th, which from what I hear from the connections is actually pretty good performance.
Absolutely.
And he actually took home $165,000 for 8th place, which is not bad. That should buy a lot of hay, but it's done nothing for my tipping sort of reputation.
Well, it's been a great ride for your family, and thanks for letting us in on it. I think it gave all of our listeners an extra interest in the Melbourne Cup this year. But Tony, let's get to our first big topic. One of the real privileges of our job is meeting fascinating people, and on Thursday we got to do that when we interviewed a guy called Howard Marks, who's the founder of a company called Oak Tree Capital Management. Now, it's got more than $250 billion under management. And it's perhaps best known for its work as a vulture fund, where it lends money to companies that are in deep trouble in order to recapitalise them. He's a fascinating character, Tony, and he was so open and engaged with us. He's known across global markets for these famous memos he writes every so often, pretty irregular, which are articles on everything from markets to interest rates to investor psychology. He gave us a bit of all of that on Thursday. What did you take from Howard Marks, Tony, about how he's seeing the world right now and why he's getting a little bit excited?
Well, it was really interesting when we sat down with him because he had a little sort of carry bag which he brought to the table, and he reaches inside and he said, "I've got a gift for all of you." And of course, I was thinking a sort of an oak tree cap, baseball cap or something. Anyway, he pulls out a sheet of paper, pushes it across the table to myself and Jonathan Shapiro, and there's this list. It's got investor psychology moving from flawless toward hopeless. And this is really interesting. He folds it in half and he says, okay, here we are, late 20 to early 21. And there's a list of all of these different things that have, I suppose you'd call them macroeconomic inputs: Fed behaviour, inflation, economic outlook, risk aversion. And as you look down the list with the paper folded over, you've got all those typical signs of excitement, signs of over-exuberance in markets, and the animal spirits have gone crazy. And then he says, okay, unfold it. And then you unfold the sheet of paper and it has now, and the Fed behaviour restrictive, inflation 40-year high, interest rates full and rising, buyers reticent. I mean, you get down to the list and it's actually very gloomy and pessimistic, and you think, wow, what a terrible world we're living in. And then he goes back to... Yes, I'm the contrarian. This is the time for buying bargains.
Yeah. I mean, he's excited, isn't he? I mean, you could feel really since the global financial crisis, when rates were cut to emergency levels and stayed there, economies were pumped full of stimulus. It's been hard for someone like Oaktree because there just hasn't been a whole lot of pain in the world, but. Howard can see a little bit of pain coming now, and it's got him up and about. Yeah,
I mean, one of the best lines that I think is in your story that was published on Friday was that his opportunities fund maintains a list of all the things that they want to buy, that they're on their radar. In March, it was 20 lines long. In June, it was a whole page. And now he says it runs to 5 pages. So there's lots of course, he won't reveal anything about any specific stock, which makes it hard for us to pass on the Oaktree.
To follow him in. Yeah. Well, one thing, Tony, is he was effusive in his praise. I really, we can't overstate this. Praise for our superannuation system. And, yeah, okay, there'd be plenty of superannuation funds that are Oaktree customers, so he's got a vested interest in praising it. But it's what it does for the country, I think, that he was sort of most excited about.
Yes, exactly. He agreed with me that it was a great strategic asset for Australia. He described it as one of the wonders of the world, and interesting, it triggered his own sort of historic analysis of what's happened in America, and how he said that the American worker in 50, 60 years ago had great financial security because of 4 things: savings, private pension, social security and home equity. And he reckons now in 2022, 3 of those legs have disappeared and the only one left is social security. And he says that really helps to explain why there's so much social division in America at the moment, because the American worker has basically been left behind or poorly served by its country's policymakers, whereas our savings system is now 1.5 times GDP. And at the ASIC forum this week, you may have heard Paul Schroeder from Australian Super said it's going to be 4 to 5 times the GDP, which is a tremendous reserve of stability for a country that, is facing some pretty challenging issues over the next 10 years.
Yeah, absolutely. The Americans are looking on with envy. We asked Tony what are the indicators that Howard Marks is watching at the moment, and I expected his answer was sort of going to be, I'm watching high yield bond spreads and I'm watching the 2-year treasuries versus the 10-year treasury. But he sort of took a very different approach, and he referred us to his first book. What are some of the slightly weird indicators he uses to judge the mood of the market?
Well, we were lucky enough that he handed us his latest book. It's called The Most Important Thing, and really, when I went through it earlier today, there's lots of, I suppose, lists. He loves the listing of things that are going to give you the right sort of psychology. And when you look at it, he says to you, go down and tick all of the things that apply today. And usually your time to invest is when all those things are negative. Yeah, it's a little bit unusual. He's sort of saying that as soon as things move from flawless to hopeless, that's the time to invest.
Yeah. One of the great ones I loved was he said a great indicator is whether people are mobbing him when he goes out to a party. If people are all over him for investment advice, he knows that there's plenty of exuberance. If no one wants to talk to him at a party, he knows that the markets, people aren't interested in investing, and that might be the time to invest. Okay, Tony, the big question coming out of our chat with Howard Marks, do you agree he's right that he's going to be seeing lots of opportunities in distressed companies over the next few years? And how long do you think that will last?
Well, he reminded us that he'd picked the 5 big turning points over the past 20 to 30 years, and that's pretty impressive. But he was very careful to say that we're not at the turning point yet. He thinks we're about 80% there. So what he's saying is that there's a lot more pain to come, but I think it's very difficult for any investor to pick the bottom of the market. So perhaps he's right that now is the time to be sifting through all those opportunities you can see, and one that was really right at the top of his radar is China.
Yeah.
Now, they have a business there, Oaktree, so he's no interest in him criticising the Chinese government or Communist Party. But the fact that he says there's this big pile of opportunities in companies listed in China, to me sounds like an interesting area to explore if you're an investor.
I think he's going to get plenty of opportunities in the next couple of years, Tony. I think the fact that there's a 5-page list in inside Oaktree tells you that there's a bit of stress to come. But I agree with you. I thought what was really interesting is that he said he's made a lot of money over the years investing in things that everyone else thought were uninvestable, that the places where people are scared to go. So, they say the best investments are made when you're uncomfortable, and that's perhaps a little tip from Howard. You don't shy away from those things which make you uncomfortable. Be prepared to look in those places. Tony, one of the things that is changing Howard Marks' view of the world, of course, is that interest rates keep rising, and that is creating economic pain. We saw that this week. 2 prime examples. On Tuesday, the RBA raised cash rates by 0.25% to 2.85%. And then on Wednesday night, the Federal Reserve went big. They went with a 0.75% rate hike to take their rate to 3.75%. Tony, this was largely as expected. But what was your read on the RBA? I mean, Phil Lowe gave an incredible follow-up speech after raising rates where he called inflation evil, which is a bit fire and brimstone for an RBA governor. What did you make of that?
Yeah, well, he gave a speech down in Hobart because they held the RBA board meeting on Cup Day in Hobart, and it was during that he said the evil of inflation would be with us for longer, and the eventual increase in interest rates were needed to bring that down. Otherwise, we'd have a severe recession and very high unemployment. So, but I think one of the most interesting things in that speech was that he said they had acted strongly. Now, that was the 25 basis point rate rise that I did tip, and you said 50, by the way.
Yes, noted. Noted.
But no, the interesting that he says that 25 basis points was acting strongly, because there are commentators in the market who think that he's not going hard enough, that he should be doing what the Federal Reserve is doing, and maybe even, a 50 now and another 50 next time. But I think they've got the right idea that it's monetary policy is a lagged method of trying to slow down an economy, and you should wait for the cumulative effects to come through. And I think that's what they're doing, which is the right thing to do.
Yeah, and as you said, the Fed is taking quite a different tact. I mean, everybody was in the markets were hoping that the rally we saw over October could continue and then the Fed would get a little bit dovish, that they'd say something along the lines of interest rate rises won't need to be so large going forward. And they actually did say that they did say that in their official statement, that, you know, that they said that it would become appropriate to adjust the pace of rate hikes. But then Jerome Powell, in his traditional press conference about half an hour later, he turned very hawkish and basically said, don't worry about how fast we're raising rates, worry about how high we're going to take them and how long they'll have to stay there.
You
we
stayed up for that press conference, didn't you? It was quite late.
I got up early, yeah. And there was this incredible turnaround in the market. When I got up at about 5 a.m., the market was up, 0.5%. By the time Jerome Powell had finished speaking, the market was down 2.5%. I mean, it was incredible that reality sunk in. But Tony, you wrote this week that you reckon the Fed is, quite content, almost trying to bring on a recession, where the RBA is really trying to steer that soft landing path.
Yes, well, look, as we know from our conversation with Howard Marks, be very wary of anyone's forecast. So that's my sort of caveat on all this, because he seemed, I think Howard says, don't worry about the forecast, just get your own, psychology of investing right. But the thing about what the Fed is doing is that we don't really know if they do slow down, whether that means that the end rate that they finally get to, what it will be. And we don't also know how soon after that they will start to cut. I think there's a growing realisation in America that we're going to have high interest rates in that country probably till 2025. And, I mean, what do you think the terminal rate might be in the United States at the end of all this?
Well, I think prior to Thursday, the prediction from the market was about 4.9%. It's currently sitting at about 5.1%. I think they're going to end up over 5%. I think inflation's going to prove really sticky, and I think Jerome Powell is determined to push rates to a point where really rates are above inflation. And we're still a long way from that. So I'm betting the terminal rates over 5%. Tony, are you on the other side of that bet?
Yeah, look, I think it's currently, 3.75 to 4, so that's quite a lot more to go. I'm not sure, James. I mean, I think the equity risk premium in capital markets is still pretty high, so there's probably some danger still in risk assets. But, probably less than 5%.
Okay, fair enough. Now, just one other point, Tony. We've seen this week as rates are rising, the housing market in both Australia and the US is starting to come off very quickly, falls accelerating in both countries. Is this something to worry about, or is this something that will actually make central banks happy because there was such a big boom in house prices during the pandemic year, and this is a bit of the air coming out of the balloon?
Yeah, I think this is really what the Fed in America wants, and it's actually working. Housing starts in America have fallen to 1.43 million annualised, which is down 18%, and there's a even higher percentage fall in new home sales. So there's lots of, I suppose, reasons why unemployment will rise in America, because housing construction will be hit very hard. Refinancings of mortgages are down to a 20-year low. So, yeah, there's a whole lot of, I suppose you'd say, evidence of tighter monetary policy, and this is really what the central bank wants, to get inflation under control.
Yeah, I think the RBA is the same. I mean, they're not going to be too upset about seeing house prices come off the boil and some of those pandemic gains taken out of the system. Well, Tony, we're going to come back after the break with a look at bank results, consumer confidence, and the COP27 summit, which has just got underway in Egypt and really heats up next week. Tony. Well, talking of interest rates, it's another big week for the banks next week. On Monday, Westpac's going to report its full-year results, and then on Wednesday, it's NAB's turn. We've seen a good result from ANZ. The rising interest rates are really helping the banks. More of the same coming this week, do you think, Tony?
Yeah, I think probably that's right, James. I mean, Westpac is always an interesting bank to watch because, you know, it's the one that has fallen from great heights, and Peter King has got a sort of turnaround strategy there, which did have quite an ambitious cost target, which got abandoned. But that bank's rallied pretty hard into this result. I think it's up 20% since the 1st of October. So there's some pretty high expectations for this result. I'm not sure. Let's see what happens. That's The target to get annual costs down to $8 billion, it still hasn't been abandoned yet, Tony. It's still there. But the question is, does it stay past Monday? And I think that maybe I've jumped the gun there.
I think that is a really good question. And the pressure on bank costs, obviously, we've seen with cybersecurity costs are still going up, and the wage inflation is still rising. I mean, bank wages are rising by about 5% as well, Tony. So it's really hard for them to keep a lid on costs as much as investors might like.
And what about NAB on Thursday? Do you reckon Ross McEwen's going to deliver the goods again?
Oh, I think so. I mean, NAB was that bank that was sort of accident prone to problems every couple of years. And this is the thing about Ross McEwen. He sort of just runs a very tight ship. They'll deliver some good home loan lending numbers. They'll deliver some really good business lending numbers. And I think we'll just see this, steady turnaround of NAB continue, don't you think?
Yeah, well, look, I've got a little bit writing on this one, seeing I wrote some time ago that Ross McEwen was the best CEO at NAB in about 20 years. Let's hope he doesn't get hit by the Boyd tipping jinx. But no, I think NAB is really a very different institution to what it was many years ago. Just like you say, really tight discipline management, and it's just a sharp focus on what needs to be done.
Yeah, around the bank results, we'll see some consumer and business confidence numbers. Tony, these are going to be really interesting over the next few months because as rates continue to go up, what is going to happen to the mind, the psychology of the consumer and of the small business person? Will they start to pull their horns in and spend a little less, borrow a little less? I guess the RBA wants to see a bit of a pullback, doesn't it?
Yeah, it does. I mean, the last Westpac Consumer Confidence Survey found that it was in deeply pessimistic territory. I mean, it was the worst since the global financial crisis. So,
but people are still spending. So how does that make sense?
Yes, it is strange, isn't it? The Westpac was saying that it was, that people were hit by rising living costs, rising interest rates. But yes, you're right. It's not necessarily showing up in retail sales, is it?
Yeah, and that's the great question for me. I mean, people do naturally get worried about all these rising cost of living pressures, but then we've got the fact that spending continues to go along, and part of that is about that people need to spend more to meet their, petrol bill and their food bill. So, but it's going to be interesting to see when this starts to crack, I think. The RBA needs it to slow down really quickly.
Yeah, and I think that as far as business confidence goes, NAB's last survey said that the conditions were steady broadly in the third quarter. Trading conditions and employment edged higher and profitability edged lower. So that'll be another litmus test, I suppose, of what's happening out there. But basically a lot of business has been hit by these higher energy costs and higher inputs and all of the supply side constraints caused by Russian invasion of Ukraine, which keeps coming up every time you talk about any aspect of inflation in the global economy.
It's still that black swan. Last one, Tony, COP27, starts in Egypt. Well, it started on November 6th, goes till November 18. It'll start to ramp up a bit. It's funny, isn't it, Tony? COP26 in Scotland last year was such a major global event. COP27 seems to have faded from view largely. What does that tell us?
Yes, I agree. Just the fact that our Prime Minister, Anthony Albanese, is not going, I'm not saying there's anything wrong with what Chris Bowen will do there as our Energy Minister, but Albo seems to think there's other priorities in Australia, whereas it was very important, even for a very sceptical previous government, to be in Glasgow. But yes, I wonder, because one of the big things to come out of COP26 was all that agreement by financial institutions to lend $1 trillion to the decarbonisation. And since then, big investors and some big banks have pulled out of that or pulled back from it. There does seem to be at the moment a worldwide, I suppose, pulling back from the tougher approach that's needed to keep the world's temperature from rising by more than 1.5 degrees.
That's right. I think you're right, Tony. I was reading this week in the New York Times that we're seeing a lot of companies sort of edge back from their own individual ESG promises too, which goes to that wider point. Now, there's a lot going on in the world. Macroeconomic conditions have worsened. The war in Ukraine is a big overhang, but this is the worst possible time for a stalling of energy transition ambitions, isn't it?
Yes, it is. And, of course, our little microcosm of that is AGL.
Yeah.
Now, that's progressing, and it seems as though Mike Cannon-Brookes might get up. Do you think that this particular little, I suppose, example of energy transition is one that will be held up as a role model around the world for how to change a company's entire direction?
Perhaps. I mean, you're right. It is essentially a fight between Mike Cannon-Brookes, who wants to go as fast as possible, and the AGL board that's warning it's going to be impossible for AGL to reach its the sort of emissions reductions Cannon-Brookes wants to see and keep the lights on. So you're right. It is a great case study of this battle, and it's hard to know where it ends up. I mean, Tony, the big question out of COP27, or what they're hoping for, is a sort of recommitment to limiting warming to 1.5 degrees. Do you think that's still possible, or is it is it a pipe dream now?
Well, let's hope it is possible, because every prudential regulator in the world has warned that the disorderly transition will be so disruptive to the financial stability of the world that this is something that we really have to hope is achievable. Yeah. Because the alternative is just such a dark, horrible place to go.
Yeah, I totally agree. But I'm a bit of a cynical worrier. But I'm starting to worry about this one. I just think the momentum has stalled. This energy crisis has changed the focus for governments and businesses, and hopefully COP27 can come up with kickstart this push for 1.5 degrees again. But I'm not bullish on that. Let's see. All right, Tony. Every week we invite questions from our audience. You can send us an email at chanticleer@afr.com.au and ask us a question. And we're thrilled that John Cahill from Mossman, he's a great friend of the podcast, and he sent another question in, which I'm slightly paraphrasing here, John, if you'll indulge me. John asked, a $5 million cap on super balances now seems a certainty. Will large self-managed super funds be likely to be forced to sell assets and distribute after-tax sale proceeds to beneficiaries? Now, there's a bit in here, Tony. We talked last week about the potential for the budget to look to make changes in the areas such as superannuation. Do you think a cap of some sort, $5 million or some other place, is in the right place?
Yeah, I think it makes sense, James. Our very good reporter in Canberra, Michael Reid, who used to work at the RBA, he wrote last month that capping super balances at $5 million would result in an annual boost to the budget of $1.5 billion. Now, that's the sort of thing that Katie Gallagher, the finance minister, will be looking for. And I think the reality is that having 5 million for a couple, which I think is the current limit is 1.6 million per person, so a couple would be under the 5 million, is potentially enough to live on. Now, for if you're saying that 1 million lasts you 10 years, then that's going to last you 50 years and you retire at, say, 65. Now, obviously, maybe the millennials will be living to 110, but that should be enough money for those people who decide to leave work at that point in time.
Yeah.
So, it makes sense to me. I mean, what do you think? There are, by the way, 11,000 Australians with more than 5 million in superannuation.
I think it's an issue that's going to continue to come up. I mean, we want to make sure that the super system's working for everyone. I actually, the second part of John's question is what sort of interests me. How would you get the SMSF's self-managed super funds to reduce their balances? Selling assets, distributing after-tax sale proceeds. I mean, it would be a fairly messy transition, wouldn't it, Tony?
Yeah, look, there'd have to be some consideration given to how people go about doing this. I mean, there's no sense in enforcing a mass fire sale of assets. I mean,
that's right.
That's just going to help people like Howard Marks. I mean, yeah, look, it'd have to be done in a sensible manner, but it sounds like it's a good permanent change to the way in which superannuation is used as a tax-effective vehicle.
Yeah, well, it's a debate that will continue to rage over the next few years, that's for sure. Tony, thank you so much for joining us again today.
And thank you, James, and have a good weekend.
Fantastic, and thanks for listening. If you like the podcast and you want to hear more, consider rating and reviewing us, as it helps others find us. And follow us on Apple or Spotify or wherever you get your podcasts. At The Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to The Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thomson, and Tony Boyd, and it was produced and edited by Lap Fan and Alex Gow. The executive producer is Fiona Buffini.
The Australian Financial Review.